Hey, accounting students. This is a video lecture for chapter number 5, and I'm not going to cover every single topic you see listed here. I'm going to go over a couple of the problems, homework problems, real short ones. I should say short, the easier ones at the end of the chapter. Yeah, I want you to redo as homework you turn in. But the main topic here in chapter 5 is when one company in our consolidated group transfers an asset, could even be a liability to another company in that same consolidated group. And most times when we transfer assets, what we really are doing is selling it from one company to another company. Again, those two companies are under in the same consolidated group. And we are not going to report any gain or loss on those type of transactions until that asset is transferred or resold outside of the consolidated group. So we'll take a look at just an example dealing with inventory and not dealing with other examples in our textbook for chapter 5, like land or depreciable assets. Let's get a overall view of how the amounts are flowing between the two different, let's say, two different entities in our control group. So in our homework, we're going to see the two companies are Alpha, that's A, and Beta, the wholly owned subsidiary, maybe not wholly owned. There's even non-controlling interests discussed in this chapter 5. But we can have sales, yeah, from A to B or from B to A. Going down this way is called downstream, yeah, parent selling to subsidiary. Or going this direction, subsidiary selling to parent, that's called upstream. In our homework example, the situation is a downstream sale. So all of us remember from our first accounting class how to calculate out selling inventory, hopefully at a profit. That's the sales price you get, minusing out that merchandise's cost of goods sold. And we went through the cost of goods sold calculations, of course, dozens of times in our previous accounting classes. That's the beginning inventory plus the purchases you made during the year, and that's equal to the cost of goods available for sale. And then we subtract out what we didn't sell, the ending inventory. All of these three amounts here are at our company's costs. And then we take a subtotal to get that cost of goods sold. So here is the cost of the merchandise we sold. And here is the sales price of that same merchandise we sold to get our company's gross profit. And the subsidiary would go through the same calculation. Remember, each of these entities prepare its own financial statement. And what we're learning in our class is to combine them together, eliminating any intracompany transactions. And one of those transactions can be the sale of merchandise from one company to the other within the same consolidated group. For example, we'll see a sale of $100,000, and that sale is going to go to our subsidiary here as purchases during the year. And because it's between companies in the same consolidated group, we should back that out because you shouldn't report any sale and profit you make by selling to an affiliated company. But if this merchandise is resold outside of the consolidated group, then we should report this ultimate sale and the original cost of that 100,000. Okay, not reporting the sale up here, not reporting the amount they bought at 100,000 here, but the original cost and the sales price when we sell outside of the consolidated group. So in our chapter 5, let's see if I can show you a few pages here. It goes through examples of journal entries, some new ones besides the S, A, I, D, E, and C we've learned in the previous chapters. Here's one called transfer of inventory, TI, to get rid of the sale to the sub, to get rid of the cost of goods sold that's included in from the sub. From the sub, yeah, the sub's cost of goods sold, and only keeping the cost of goods sold of the parent, and only keeping the sales of the sub. Again, let me go back here. This is the cost coming in, yeah, to the parent, and that's the cost of goods sold included here. And here, when we sell out to the outside of the consolidated group, we're keeping this sale over here. So we're eliminating this sale. We're eliminating really the purchases by reducing the sub's cost of goods sold. And that's what this journal entry is doing over here. But the profit on the sale by the parent of the sub is still within the accounting record. So you even have another entry here to get rid of the profit. Let me show you this one over here. Getting rid of the profit. And the way they do that is not to reduce the sales price, but here increase the cost of goods sold, debiting, yeah? And via really reducing the inventory. Is that how I do it? Let's see. If I reduce this inventory here or here, that's what you're doing here, crediting inventory. What you really are doing is increasing the cost of goods sold and ultimately reducing the profit. So a lot of this is indirect, making changes to a couple accounts up the line here to affect the gross profit and net income at the very bottom. Okay, so I guess not confusing us anymore, let's take a look at the homework problems. So in our textbook, here at the end of the chapter, the problems are problems 4, 5, 6. Yeah, it may be labeled differently in our assignment, in our Connect assignment. Yeah, so we have alpha, that's the parent, owns 80% interest in beta. This 80% implies that we have a non-controlling interest of 20%, but it's not going to matter because this is a so-called downstream sale versus upstream that may take into account this 80%. So we're given the balances in our accounts here. This inventory is the ending of the year inventory. So 95 for alpha. And this is a good number to use in our consolidation because we're assuming that all the merchandise purchased by Alpha during the year came from outside of the consolidated group. But Beta's ending inventory, 88, includes some of the purchases made from Alpha. So that has to be adjusted. Okay, because it's inflated because there's some profit here when Alpha had sold it to Beta. Sales revenue included in this 800,000 is sales also made to Beta, so that has to be backed out. No sales were made from Beta to Alpha, so this 300,000, all of it was to outside parties, so we don't need to adjust that. Cost of goods sold, this includes what was sold to Beta, and that has to be adjusted. This 180 possibly includes some of the cost that was purchased from Alpha. Okay, so we need to know how much was sold by Alpha to Beta. And here we're told it was $100,000. This 100,000 is included in this 800,000. Okay, so I think that's the first question here. Also, we're told that Of that 100,000 sold by alpha to beta, 60% of that 100,000 or $60,000 was resold. We're assuming outside of the consolidated group. So 40% or 40,000 of this 100,000 is still here in beta's inventory at an inflated price. Okay, so let's do the first question here. What is the total consolidated sales revenue? So let's see if I can illustrate this out on a new page. Where's my new page? Can I go in? No. So I have my new scratch paper here. So again, we have alpha, the parent, owning beta, and what's the sales for each of them here? Alpha's sales is 800 and beta's is 300. So 800, I'll just do the thousands here, and 300, of which included in this 800 is 100 that was sold to beta. And again, we don't recognize sales within the consolidated group. So we got to back out that 100,000, really reducing this 800 by 100, yeah? Resulting in $1 million million, if I put in all the zeros here, of consolidated sales. So looking at our possible answers here, answer C. Let's take a look at problem number 5. Here asking for the consolidated inventory. So let me illustrate this out on another blank screen. And again, here is alpha owning beta and the inventory for alpha. Inventory for alpha, 95, and beta is 88. 95, 88. Okay, so remember now, alpha had sold 100,000 of merchandise to beta. Now, some of that 100,000 is inside of this ending inventory. How much? Well, let's look at more facts that were given to us. If I can bring it up here. Beta had resold part of that 100,000, 60% of it, to outside of the control group. So that means 40% or 40,000 of that 100,000 is inside of this 88. Yeah. So let me draw that cost of goods sold calculation here. Beginning inventory plus the purchases, which is really this 100,000 here, less the ending inventory, which is really this number over here, equals the cost of goods sold. So what we got to do, remember there's only two things you do at the beginning inventory and purchases. Either you sell it, here cost of goods sold, or you don't, ending inventory. And of this 100,000, 60,000 was sold. So 40,000 must be in here. Okay, so inside of that 88 is 40,000 of purchases from Alpha, and it's at an inflated price. So how much did the alpha mark up that merchandise it owned and sold it to beta? Again, we got to look at the facts given to us here. Alpha sells inventory to beta at the same profit, at the same markup it sells to all its customers. In other words, Alpha here sold 800,000 and it cost them, Alpha, 600,000. So it made a profit of 200,000. And included again in that 800 is the 100 sold to beta. So we need to figure out how much they marked up, how much profit they made on that 100,000. So we got to get that ratio, yeah, that gross profit percentage. So let's calculate that out. Let's go down here. So the formula is sales price 100, no, 800. This is everybody, yeah, including beta. And less cost of goods sold, that's 600, gives us a gross profit of 200. Yeah, gross profit is an important figure. So we take a percentage of that. And typically, when you take percentages, you divide by the largest number you see, which is the sales. So, well, let's take a percentage of everything. 800 divided by itself would be 100% of itself, right? 600 divided by 800, that's 75%. So obviously the gross profit margin or gross profit rate is 25%. Okay? The company made a profit of 25 cents for every dollar it sells to anybody, including selling to beta. What it sold to beta was 100,000. Again, we split it up. 60 was sold and 40 is still here in the ending inventory. And it has made a profit. Alpha has made a profit of 25% of that 40. So what we got to do is reduce this 40. We really reduce the 88 by the profit that's built into that 40. So 1/4, yeah, 25% of 40 is 10. We got to reduce beta's ending inventory by $10,000. So let me total up all of this here. That's the inventory of alpha. I think I need my calculator. Um, where's my calculator? 95 for alpha plus 88 for beta reduced by the profit of 10 inside of that 88, or 173,000 is the consolidated ending inventory. Answer B here. Okay, let's look at the last of this set of questions. Question 6, where we need to calculate here the consolidated cost of goods sold. Let me take a step back and I can show you the calculation of this consolidated ending inventory. That's this 173 we just figured out. And because we're using this 88, at least the subsidiary is using this 88, this is overinflated. Thus, the cost of goods sold using this 88 is too small. What we need to do, though, is the 10,000 ending adjustment. We need to also do it to the cost of goods sold. We really are deferring the gain of this 40,000 that we bought from the parent to the year we sell it, which is next year. And the way we do that is by carrying over a smaller ending inventory. And that means this year, this cost of goods sold has to be um, uh, increase, yeah, reducing the profit this year and moving it to next year. So again, let's take a look at this cost of goods sold calculation. Let's do it on a new page. So we have alpha, again, selling to beta, and the cost of goods sold for alpha and beta. $600 and $180. 600 and $180. And if you remember, we sold 100,000 from alpha to beta, and that has to be backed out. Remember, we only take into account uh, when it's actually sold outside of the control group. So let's back it out here, 100,000. But not all of it was sold outside, right? We have 40% of it, 40% still here in the ending inventory. And built into that ending inventory is a profit of 25%. So we need to defer that profit in the ending inventory and push it to next year when the remaining inventory is sold. So let me kind of multiply all of this out here. That's 100,000, 40% multiply 40% times the profit margin of, uh, let's start over. 100,000 times 40% times the profit margin of 25 gives us that 10, right? I'm going to adjust. And keep in mind, what we're calculating here is the cost of goods sold. I want to make the cost of goods sold bigger this year. Why do I want to do that? I want to make the profit smaller this year and push it into next year when this um, 40,000 of inventory is sold. Okay, so 600, 500. Well, I need my calculator. Let's see. Clear 600 minus 100 plus 10 plus 180. Here is our cost of goods sold for the consolidated group. Answer, what am I looking for? This is question 6, answer B. Yeah, 690. Okay, let's try one more problem. What you're looking at is problem number 10 at the end of chapter 5. And again, it's going to be a different number in our homework assignment. And you can see it's basically a multiple choice answer, but there's quite a few calculations to get the correct answer. So let's go through the facts. We have Thomas, that's the parent, owns 70% of Stare. That's the sub. And then on January 1st, 2022, our parent acquired a building. Life of 10 years, cost of 460,000. And then we depreciate using straight line. Then 2 years later, let's see, 2022, 2023 have passed by. Now here at the beginning of 2024, Our parent is going to sell the building to Stair. Remember, we don't include any gain or loss yet when we sell among our consolidated group. But the sales price is 430,400, and at the time the building had a remaining life now down to 8 years. Makes sense, right? Started off with 10, 2 years have passed by, leaving a remaining life of 8, but now with a different remaining costs. And no salvage value in our calculation for depreciation. So the question is now, how does this transfer affect the computation of the consolidated net income? This is for the year 2024, the year the parents sold the building to the sub. So let's go through all of this calculation here. Let's go to a blank sheet of paper. So let's calculate out the remaining costs at the time we sell. Okay, we start off with 460 as the original cost. So that's costs 460,000. And we're going to divide that by 10 years. I can do this in my head. 1 year depreciation is 46,000. But 2 years have passed by. That's all of 2022, 2023, and now we're looking at the beginning of 2024. So just 2 years, yeah? So multiply this by 2. Sorry, I can't do this in my head. I'm an accountant and I cannot do math in my head. 46,000 times 2. So this 92,000, of course, is our accumulated depreciation at the beginning of 2024. That's 92,000. 92. So the difference, of course, is our book value of the building. 300, 368,000. I'll put it here, 368. And we're going to subtract this from the sales price we get from our sub. That was sold this building to Stair, 430, 400. Such an odd amount. 430, 400. 400, 430, 400. And we're subtracting out the book value. To get the gain. 62,400. This is a gain that the parent reported on its books when it sold the building to the sub. And because, again, it's between related companies in our controlled consolidated group, we have to back out this gain when we prepare the financial statements for 2024. What we should continue doing is depreciating the building at this 46,000 rate per year. But when the sub bought the building at this price here, remember this is the sales price to the parent and purchase price to the sub, the sub is probably going to be depreciating this amount here over the remaining life. So that has to be another adjustment we need to make. Let's see again, 430, 400. This is the cost to the sub, 430,400, and it's depreciating it over the remaining, not 10 years, 8 more years, yeah? So divide by 8. 430, 400 divided by 8, 8680. 8680. Wait, 430 divided by 400. Let me try that again. Let me clear my calculator. 430,400 divided by 8. Okay, this is not right. 53,800. Now, this is what the subsidiary recorded as depreciation. And what should be recorded as depreciation for the whole consolidated group is this original 46,000 per year. So we're recording too much depreciation. The difference here, 53,800, 46,000. Too much depreciation in the amount of 7,800. Okay, so there's really two items that need to be changed here. We got to get rid of this gain, reduce the net income of the consolidated group by 62,400. And because too much depreciation is being taken in the amount of 7,800, we got to add that back into the profit. So what am I doing here? Reducing the profit by 62,800 and increasing the profit by 7,800. That's 62,400. So here is our answer, 54,600. 54,600. So am I going to increase my profit by 54,600 or decrease my profit by 54,600? Remember, we're trying to get rid of this gain. We got to reduce it by 62,400. We took too much depreciation, so we got to increase. So the net overall net here, this amount, is to reduce the consolidated net income by 54,600. So looking at the possible answers here, this one here, yeah? Reduce. Okay, answer D. Okay, that's the only videos I'm doing for this chapter. There's a lot more different possibilities, especially when we have a non-controlling interest, yeah? And there's also upstream sales, yeah? But again, use your textbook as a reference. And I swear, some of the questions in our smart book assignment don't make sense. Also, there's some even wrong answers. Let me show you the issues I think are in the this whole chapter and the smart book assignment. Let's go look at a worksheet. So when you read the question in the smart book, of course, a lot of us are using AI, yeah? But make sure you read the whole AI answers, and they'll tell you why the right answer is right and the wrong answer is wrong. But when you read the question, is it talking about how the parent and the sub got its numbers here in its own financial statement? Or is it talking about what it should be in the consolidated financial statement? Or is it asking you what should be the correction or here the adjustment or the consolidated entries to get to the correct balances here? I think that's half the issue. Understanding what the question is asking. Is it how we got this numbers or eventually to this numbers or the adjusting entries over here? And again, I don't think there's sometimes the questions are asked clearly in the smart book assignment. And I'm pretty sure there's a couple wrong answers in the smart book assignment. Okay. So that's it for chapter 5. Yeah, I'll see you in the next chapter.